Good morning, good afternoon, good evening. Thank you for joining us today from around the world. I'm Sharon Ho, Director of Custom Programs at Wharton Executive Education. Before introducing Professor Wong, today's speaker, I would like to go over some logistics for the livecast. We invite you to submit your questions. Please click the Q&A icon on the right side of the screen to post your questions. Later in the presentation, my colleague Ed Siri will read those selected questions to Professor for her response. And if you need any tech support during the session, please use the moderator chat function, also located on the right side of the screen. Now, it is my great pleasure to introduce today's speaker, Professor Maisy Wong. Professor Wong is the James T. Riady Associate Professor of Real Estate at the Wharton School and Assistant Director of Grayken Program in International Real Estate at the Zell Lurie Real Estate Center. Her research interests include labor mobility, urbanization, housing, and real estate finance. Professor Wong has been teaching at Wharton since 2008 and won Excellence in Teaching Award in 2018. Now, without further ado, let's hear from Professor Wong.
All right, thank you, Sharon. Hi, everybody. Thank you very much for joining us today. As Sharon mentioned, I have been at Wharton for about 12 years, where I teach a real estate finance course for undergrads and MBAs, where we talk a lot about valuing and managing risk of income-producing real estate assets. I just taught in the spring, and a lot of what I'll be sharing with you today will be coming from that experience teaching that course. I'm also the assistant director at the Zell Lurie Real Estate Center, where we've actually had our most busy summer yet, with a lot of virtual meetings and also very lively debate about what's going to happen to in the commercial real estate sector in the coming months. And so today, what I thought I'd do is to share with you a little bit of those things we've been discussing in our lively debates. Okay. So I really want to start with just giving you a general economic outlook, and because whatever real estate is everywhere, and whatever happens in the broader economy has direct implications for the physical space, the demand for physical space. And so we'll first talk about the general economic outlook very briefly, and then dive deeper into each of the key food groups in the real estate sector. And then that's the first half. And then the second half, we'll talk about the anatomy of a cycle. Right there, I tell my students this: if you start your career in real estate, you're going to go through 3 cycles. Each cycle is 7 to 10 years. And so we're at probably the bottom of the cycle right now, and we're going to think about what's going to happen in the coming months and what to look out for. And then we'll close out by talking about, where are some of the opportunities and where we are in the cycle. So let's talk first about the general economic conditions. And on one side, we'll talk about GDP, monetary policy, and fiscal policy. And on the other side of the slide, right here, it's the key bread and butter equations, the framework we use when we talk about valuing income-producing real estate assets, right? So the key thing I want you to take away from this slide is that there really is a numerator and a denominator effect going on right now, right? So no surprise, right? We have a very negative outlook for GDP, right? If consumers are spending less, right, you're going to see less spending in retail. You're going to see less spending in hotels, right? If you're traveling less, then there's going to be less demand for those property types, right? The other thing that we want to pay attention a lot to is unemployment, right? That's how it's quite different this time than the last time, which is the dislocation in the job market is swifter and deeper, and that probably means that the recovery is going to be longer. When you have so many people, right, experiencing temporary or permanent dislocations in the job market, that's going to mean that we would expect a slower recovery because it just takes time to adjust, and it's a pretty severe disruption. So as we're plotting, right, what our cycle is going to look like, right? Is it going to be a V or a W? What kind of recovery we're going to expect, right? I would pay a lot of attention to the job market and how people are going to recover from that. So that this GDP and employment job market dislocation has a direct impact on cash flows, right, for income producing assets, right? So in the key thing I have my students take away is value. The value of an income producing asset is really a stream of predictable net operating income, right, which is revenue minus expenses divided by the cap rate. So what's happening in the economy right now means people are spending less, right, in physical space and in physical commercial space. And that means there's a direct hit on profits, right, net operating income. So your landlords are experiencing less cash flows in terms of revenue. They save a little bit from operating expenses, but still on net, there's a direct reduction in the numerator, the net operating income. And so as we think about underwriting the value of real estate assets, we're going to think about how those cash flows, right, the profits, will recover in the coming months. At the same time, also very different in this cycle, in this downturn, is the response on the monetary policy side, right? So we talked about how very high quality real estate assets behave very much like bonds, right? You're getting a stream of predictable lease payments, very similar to coupon payments or bond payments, and that investors will apply a yield, a bond yield to that, and that bond yield is called the cap rate, right? So here's the denominator effect, right? Because the central banks have responded so swiftly this time, right, with a large range, a wide range of monetary policy interventions that have really reduced the risk-free rate, right? That has brought the cap rates probably significantly down, right? And so as the bond yield goes down, right, the inverse multiple goes up, that's going to have an opposite effect on the value, right? So I think what's going to happen, this is the two sides of the lively debate right now, right? That on one side, right, investors think, if office buildings, retail malls, and hotels are experiencing lower cash flows on the numerator side, right, value should come down. However, on the other side, right, the other side of the debate will say like, well, the Fed has brought down the risk-free rate, right? Treasuries are at a historically low rate of less than 1%, right? And that means that on the relative basis, right, capital is going to look for yield, right? When capital looks for yield, some of that is going to go to alternative assets like real estate, which is providing a pretty good spread, right? And that's going to bid down yields and hence bid up values, right? So those are the two forces that are ongoing, and it remains to be seen, right, what's going to happen in the coming months, right? One other thing to pay attention to is the fiscal policy, right? I think for right now, if you survey landlords, their rent collection rates have still been pretty high, especially on the apartment side, right? Some of that could be cushioned by the CARES Act, right? While many people have lost their jobs, they still continue to be receiving stimulus checks, and that means that they're able to pay their landlord, right? As this sunsets or is not renewed, as the fiscal policy sunsets or is not renewed, that's going to have a direct impact on the tenant's ability to pay their landlord, and hence will have an impact on the numerator again, right? So I think these are the three things you want to pay attention to that have like key implications for the valuation of real estate assets. So that's the backdrop for just the broader economic trends and how that has implications on just all real estate assets, valuation and risk, right? Now let me give you a brief survey of the key property types in commercial real estate. What I'll do here is what I want you to pay attention to here is really two things. One is going to be, there will be some COVID-specific dislocations or changes. The other one is you're going to see what COVID is doing is going to basically accelerate some of the underlying trends that we're going to see. Okay. So let's start with office. And in office, I think the trend we had before, right, was that there's going to be an expansion, right, in demand for office in the gateway markets, right? Like Amazon and HQ2, Google expanding its footprint. That I think will continue, but maybe there will be a temporary ebb. Although Amazon today just announced that they're expanding their physical footprint in 6 cities, right? So I think we're going to continue to see that trend. There might be some temporary dislocation because cities right now are experiencing a pretty big dislocation. Some of that is short term, right? Because there is now a flight from cities to the surrounding suburbs. Some of that's temporary. I think that will come back when the health risks go down. The part that I think office landlords are really wrestling with is the work from home trend, right? That it looks like there might be a permanent change in the way we are using our space, and that could have long-term implications, not on all office, right? But it probably will have some long-term implications on the demand for office space. How deep that the implication is going to be, right, will depend on how cities will survive and come out of this COVID crisis, right? So I just moderated a session we had on density and cities. We tend to think density is good for cities, but right now density is really exerting a large cost on cities because of the health crisis. And so a lot of this is going to mean that some cities will be hurt a lot. And the question is really, how bad is the shock going to be? How long and where? And things you want to pay attention to assess this is to first look at the public safety, right? In how is that city able to manage the health of its residents, right? So we know that it's possible to function in cities, right? Around the world, we see very, very dense cities returning to their regular activity levels. But those cities have much lower prevalence rate than the US. And so that remains to be seen. So public safety, I think, is the first thing to pay attention to in terms of figuring out, which cities are going to come out the strongest. Second, it really, I think, is a key problem for cities is public transit, right? Cities need to figure out how to make sure public transit is safe, because public transit is the way you commute and move around cities. And so as you think about the demand for office space, right, in large cities like New York, like LA, right, a lot of it is going to depend on how dependent are employees on the public transit to commute to work and the safety of that public transit. The third issue is going to be public finances. Cities incurred large expenditures in response to the health crisis, but they have also experienced a reduction in revenue, in tax revenue. So many cities have very deep holes in the public finances, and how they're going to come out of this crisis will depend a lot on, what their finances will be like. So as you look around the cities, right, I think most people think New York, yes, is experiencing a hit because it's extremely dense. However, New York has survived many deep health crises, and it will come out and it will be fine. The cities that you worry about, LA similarly is a large city, but it's probably less exposed to public transit risk. So it'll be quite different in terms of its experience in the health crisis. The cities that will win probably are the middle density cities, right, that have lower rent and also still a highly educated workforce. Those are the cities that probably will emerge as winners. The superstar cities we had previously, New York and Los Angeles, San Francisco, they will survive, but they are experiencing a temporary dislocation. So that's about cities, office, and segue to cities and how we think about, which geographies will respond. Let's now move on to talk about hospitality, right? That's no surprise. Lodging and travel is experience a deep crisis. This is actually occupancy rates in April, and it was very low, but still heterogeneous, right? The economy class and mid-scale hotels are doing pretty well. Fast forward to August, right? People have to travel and travel locally, right? So some of these hotels have come back in terms of their operational performance, But the segments like luxury and upper upscale, right, the large conference hotels, those will probably take a longer time, right? So a theme coming up is just this heterogeneity in the commercial real estate sector, and it's just about paying attention to which segments, which geographies, and which property subtypes, right, are going to recover fastest. Retail, I think you read about it a lot, right? The malls are definitely struggling. This is part of a long-term trend that is accelerated by COVID. Not all retail is performing badly, right? So some strip centers that are grocery store anchored, they've been doing well. And whatever is happening negatively impacting malls, right, is doing the flip side, or the positive has been positive for the industrial sector. The industrial sector is probably one of the brightest spots in the commercial real estate sector right now. Residential, actually, residential so far has been doing okay, right? Rent collection has been strong at the 90s. Some apartment REITs that are concentrated on the gateway markets, those apartment REITs have experienced lower occupancy rates, right? But still very, very high, above 90%. And so it continues to be seen, remains to be seen how the apartment sector will come out of this. But so far, rent collection has been pretty strong for apartments. Single family rentals actually have been performing very strongly, and we're going to continue to expect that that will be the case as people demand more space. And then the other sectors I'm not going to go into in detail would be, but I wanted to bring up as niche sectors that are really becoming mainstream, right, are data centers, wireless towers, and healthcare sectors. I think these are going to be the niche sectors that will become mainstream. And this is part of this COVID accelerating the trends that we have been seeing in the last 2 years. Okay, so we're going to see very strong demand for data centers, wireless towers. Let me now move on to talk about the anatomy. So we've talked about the cross-section and looking at heterogeneity across different parts of the commercial real estate sectors. Now let me talk about just the anatomy of a real estate cycle, right? So this is typically what happens. Every cycle is different, but generally what happens first in the cycle when there's a downturn is you're going to see the public markets take a hit first. And we saw that in March in the public debt markets with mortgage REITs and CMBS, right, experiencing very severe dislocations. And so you can see here that CMBS spreads, particularly the BBB-, right, widening, right, from 200 basis points to more than 1,000 basis points. When spreads widen, values fall. And so for parts of March and April, right, the public debt markets were really frozen. That has really started to thaw and has recovered a little bit, but still, you know, there's still liquidity issues there. That's a public debt market. It has come back, you can see, for the CMBS spreads. And so you can see that the market is a lot more liquid than it was before. And part of this is coming from the response due to the response of the central bank. Public equity markets, similarly, right, in 2019, right, across all sectors, right, REITs were doing fine, except for regional malls. This is part of a long-term trend. And then what has happened this year is that public equities in real estate have just gotten pummeled, except for data centers, and industrials have been now doing much better. So that's the public markets. What you want to watch out for now is what's going to happen to the private markets. And here is where looking at the previous cycle is going to be useful, right? So the downturn hit in 08, 09, right? But generally, right, private markets will operate at a lag, public markets. So when there's a downturn, you're first going to see shocks manifest itself in the public markets, and then the private markets transactions actually take 4 to 6 quarters before you start seeing large transactions, right? Everyone is talking about where's the distress. If we think that there's going to be such deep hits to occupancy rates to landlords, we should start to see distress very soon. But I'm here to tell you that it still takes time for the private market transactions to show up, right? So this is just telling you that even in the last downturn, it takes a while for you to start seeing transaction volume pick up in the private markets. So where are the opportunities? Where should you start looking, right? When the private market transactions come up, right? When you start seeing them, right? Where should you start looking? In fact, people are already starting to look right now. Where would you look? If you're looking at the distressed debt market, right? The places you will look would be looking for all types of distressed, and how could you what are some of the options, right, for distressed debt? So I would say here to just highlight, right, when you see a distressed debt deal, right, what are the options from the lender's perspective? The first thing for you to start, first thing is that there are 3 options for each lender, right? Because when you're approaching a distressed debt deal, what you're doing is you're negotiating with a lender who has taken over the property. And so what the lender is going to consider, it will be 3 options. One is the lender would work it out with the borrower where to extend the loan, right, or write it down. And this is what we're seeing right now. Lenders are doing that right now, which is why you're not seeing foreclosures yet. So lenders are working it out with the borrower, giving them extensions. Once they decide that they don't want to extend anymore, right, then this is when you're going to start seeing opportunities to buy distressed debt. And in 2 ways. One is you're going to see DPOs, which are discounted payoffs, meaning borrowers will start paying off the discounted mortgage balance, or lender, but you can think of it as just lenders are selling the note or the mortgage, right, at a discount, and that's the fastest way to resolve any default. The other way that you most commonly read about is a liquidation, and that means the lender has decided they want to terminate the loan contract and they want to sell the property. That usually takes longer, and where you're going to see the faster liquidations is to look at whether the state in the US is judicial or non-judicial. Judicial means you have to go through the court process, and that tends to be longer because you have to go through the court to take over the title and then sell the property. Whereas in non-judicial states, right, it's much faster for the lender to take over the title and then liquidate the property. So when you're going to see distressed debt is really when you start seeing lenders take over control of the property and then start selling either the mortgage or the property, and that's when you're going to start to see distressed debt. That's why it takes 4 to 6 quarters for this lag in the private sector, in the private market. One more thing I want to bring up is mezzanine debt. That's probably another avenue for you to look for distressed debt opportunities. And here's one example of something that happened in 2010. Okay, so this is the John Hancock Tower. It's a trophy property in Boston. It was valued in 2006 at $1.35 billion with 3 pieces: equity, mezzanine, and senior debt. Mezzanine was $200 million, and during the downturn in 2009, right, some distressed debt investors actually bought this $200 million piece from Lehman, Royal Bank of Scotland, and Greenwich for 30 cents on the dollar. So it was it was a deep discount. So they bought this mezzanine debt piece for 30 cents on the dollar. Why is the mezzanine debt piece interesting? It's interesting because a mezzanine loan is a mix of equity and debt. So it gives the holder of the mezzanine loan a faster way to take over control of the property, because you don't actually have to go through the court to take over the title, to take over control of the property. So the earlier distressed debt deals you're going to see are going to be mezzanine debt deals. And so what happened is they took over control of the mezzanine piece, which gave them the right to take over control of this building. And then within a year, they were able to sell it at $930 million. It was not a pure flip, right? They still did like bread and butter real estate by upgrading the lobby, making improvements, and then leasing to Bain Capital. But this was a very successful distressed debt deal through the mezzanine side, right? So that's one example of a type of distressed debt deal that you might see. And these are the types of deals where I think you would start to see them in the earliest parts of the distressed cycle. I'm running out of time, so I'm going to stop. One more thing I'll bring up before we turn to questions, is sale-leasebacks is the other thing that you might start to see. As corporations need to raise cash, they're going to have to look for places to sell assets, and some of these corporations will start to sell real estate assets. So other types of deals you might see during downturns is sale-leasebacks, where a corporation will basically sell their space here, right? Like Denver retailers will sell their real estate space and lease it back from the landlord. So sale-leasebacks is another place where you're going to start to see more transaction volume. So let me stop here and turn to Ed, who will have some questions. I'm sure we'll have some questions.
Great, thank you, Professor. We do have time for a couple questions here. We want to thank everybody for typing in your questions and for listening this morning or this afternoon, wherever you're located. Now, Professor, I just want to make note of a point that somebody noted too. They're seeing reports out of New York City, Los Angeles, San Francisco, showing that maybe some of the temporary dislocation is shifting more towards a permanent one, partially because of, or largely part of taxes. Do you see that becoming a trend in other cities as well, or how do you think that will play out in these cities that you mentioned maybe aren't seeing as big of the effects long term? Yeah.
That's certainly something that is hotly debated, right? I think people are very worried that as cities have these public finance deep holes, they're going to start increasing taxes. And as they increase tax rates, that's going to cause people to leave the cities. And that's why I was saying they're still debating this. So one thing to definitely pay attention to is whether the federal government is going to offer any type of bailouts to cities. That's one. Second thing I'll mention is I think who are going to be the winners of the increases in tax rates in the big cities is I think those cities I talked about, like the Austins, right? The cities that are not very small, they're middle size, and they have a very educated workforce. Those are the cities who will experience a demand shock from the exits from the big cities.
Great, thank you, Professor. So you provided some great data, and your timeline of things is very well thought out. But the wild card here is a vaccine, right? So if we get a vaccine in early 2021, does that change your projections or your way of thinking?
Yes, I think that's something that people are definitely paying attention to. I would say that if we know for sure that they will have a vaccine in early 2021, it'll do two things to my risk assessment, okay, and my outlook. One is well, it's going to remove a lot of uncertainty on whether we will get a vaccine, and that's going to be huge. But two is I think many people are now starting to figure out that it's not going to be a V-shaped recovery. Even if we get a vaccine, it just takes a while, right, for the effects to show up. And when we're coming back to like the numerator, right? When are we going to see values come back, right? And operating performance recover for real estate landlords is when people start spending money in physical space. And that, I think, even if we announce a vaccine for early 2021, it will still take a while for people to start feeling comfortable and for the vaccine to start reaching a mass large enough, right? So that, I think, is still going to mean that the recovery will still be slow, except now it's going to be less uncertain.
Great, thank you, Professor. And I'm going to turn it back over to you for some final thoughts here in a minute. I just want to point out that we will also be providing everyone with a copy of the link of the recording and the presentation. I know you have been asking about that as well. So before I turn it over for final thoughts, Professor, a final question would be, what should we be looking out for in the coming months here? We've kind of been home for a while now, don't know what's coming, a lot of uncertainty. What should we be looking out for in your opinion?
So I think the two things we want to definitely pay attention to, apart from the vaccine, is the stimulus, right? Whether the federal government is going to renew the stimulus, that's going to be huge. Because we talked about how the value of an asset has to do with the how much people are spending to consume space, whether tenants are able to pay rent, and that will depend a lot on the stimulus from the government. Second is how cities are going to come out of their financing deep hole that they have. Those two things are some things to pay attention to. And in closing, what I would say is that as you think about, where to look for opportunities or where you think the recovery will be fastest, we come back to our fundamentals, which is this location, right? Does this location have strong fundamentals? Does it have strong leadership? Is there a good relationship between the landlord and the tenant? Does it have strong cash flows? I think those fundamentals are still going to hold true. And there will be certainly, as in the survey, in the overview we see, right, there will be certainly a lot of heterogeneity in which locations will recover first. And so a lot of what real estate investors are doing right now is really their homework in trying to figure out, which locations will come back first. And that is what this framework of cash flows and risk is going to help you with. And now I'd like to hand it back to Sharon, who has some announcements to make.
Well, thank you, Maisy, for this very insightful session. And thank you, everyone, for tuning in. Please know that the recording of the session will be available 24 to 48 hours after the session. Also, we would like you to know that we have an oncoming real estate program titled Assessing Commercial Real Estate Investments and Markets in the Era of COVID-19, which will be running from September 28th to October 2nd of this year in a live virtual format. Please check out Wharton's whartonreinvestment.com for more information. And we ask you to please to stay connected with your friends here at Wharton through our social media pages and websites. At the very end, on behalf of the whole Livecast team, we would like to wish you a good day and thank you for your joining us.